well, where do we go from here? We've heard about all the problems with Dodd-Frank. So if we don't want to have if we want to avoid another financial crisis and learn from the lessons, what should we be thinking about at this point? And I think one of the first things to do is to realize that the legal superstructure that we have keeps up with developments in the market. That's very important. And I think it's something that often, particularly supporters of free markets, sometimes forget is that markets depend on legal structures and legal property rights to make sure it's clear on how property rights are handled. And we've seen just in the last 30 years remarkable changes in our markets, both the speed, the complexity, the innovativeness. Just the internet alone has created amazing new issues for financial institutions, and the entire kind of computer revolution in the last 40 years has really changed many things. And we need to make sure that the financial regulatory structure certainly keeps up with that. And also that implies thinking a little bit more internationally about how we deal with these issues. And I think that means in terms of resolution as well. Certainly Dodd-Frank took one approach towards dealing with resolution authority. And I think many of the critiques about that have been well discussed here. But I would say that I think it is important to continue that dialogue and thought about how to make sure that we do have a superstructure that deals with and can properly resolve the largest financial institutions. I think it's an important issue that's still ongoing. I think the FDIC is taking a good faith effort in trying to figure out how to do it. But it's also an area where I think my experience with the banking committee is that more thought needs to be done in a constructive way, particularly by folks who favor free markets. But I also think that too much focus on resolution and that viewing too big to fail only through that prism is somewhat problematic, and it misses really, I think, is almost a more important aspect is to avoid that situation or to increase your policy options if you get into another financial crisis. And quickly that boils down to is making sure you actually have a competitive and dynamic financial markets industry. If you think back about the financial crisis, one of the things that actually was good and that helped avoid even some worse problems was that there were a fair number of institutions that had the balance sheets to assume other institutions that had gotten into trouble. So that is very instructive. That's typically how, even with smaller institutions, how banks are resolved. That's the optimal way, is to have another bank assume it, but purchase it. Takes it away from having the FDIC and any prospect of taxpayer assistance there. So if you want to create a marketplace where the market takes care of these issues, so that if an institution finds itself in financial trouble, which you in many ways you expect is going to happen in a competitive market. Sometimes bets don't pay off. That's what we expect. Is that you have options for institutions to be able to come in and purchase that institution. But I think this is where I think systemic risk regulation now comes in, is that Dodd-Frank, particularly through Section 165, is imposing a very rigid financial regulatory structure on any institution over $50 billion. I think I'm very concerned about the long-term consequences of that, particularly for the competitiveness of the market. And so more specifically, what are the concerns? One is that it could start to focus in creating a more utility-like regulation and creating banks that think more like utilities. I think one of the concerns that we saw during Dodd-Frank was many of the supporters of Dodd-Frank viewed banks not as private entities and as private companies to be part of a free market, but more as public instrumentalities, almost public utilities. And that was the thinking of some of the discussions there. And I think that's highly problematic. The moment you start viewing banks as utilities, that means they start to offer the same products. There's no innovation. They have the same risk strategies. And that last point in particular, I think, is something that is not getting enough appreciation, is that the risk, if systemic risk regulation means that every institution over $50 billion suddenly starts to move towards the same business model, the same type of capital regulation and risk management strategies. You run into a real kind of lemmings of impact as well, where they're all susceptible to the same type of shock, rather than having banks with lots of different risk models, lots of different risk strategies, where one may not pan out, but the other ones do. And that diversity of a market is healthy. It's where innovation comes from. And I think from a too big to fail perspective is critical. You have more options if there is a financial crisis. Certainly saying that more competition is going to be helpful to solve a problem is not a radical thing to say at Cato. And but I think it's something that it's very difficult sometimes in this political environment to suggest that competition still is a good idea. The approach of Dodd-Frank is so heavy-handed in terms of regulation that I think we're losing sight of the importance of making sure you have a vibrant, competitive market. And that's not only just good for consumers, but it's also good for taxpayers. It's good for the innovation of the market. So I'm happy to discuss more of that, but I'll just leave you with one additional thought, and this comes back to the kind of political side of things, is that the other important aspect I think I've come to appreciate on this is that the important role that Congress can play in these issues. It's often thought of as Congress passes a bill delegating authority to the regulators, and then it kind of checks out and it lets them do their job. But I think a more healthy oversight by Congress is also helpful for the regulators to make sure they do their jobs, make sure they implement statutes correctly. But it also means that there's a better dialogue between, I think, the American people and Congress on what's happening in financial regulatory space. Because at the end of the day, making sure the American people understand what happens in finance is very, very important. If there's one lesson I took from my time on the committee, is that an informed electorate on these issues is critical, because they can be complex, these issues, and particularly in a crisis. It's oftentimes people don't understand what's going on. And having members of Congress more engaged actually in the oversight process of financial regulation will make them better able to speak to the constituents about these issues. I think forums like this are wonderful about making sure that these issues are thoroughly discussed, so that it helps us make better informed decisions, and especially as we think about what are the next steps we take, to correct some of the mistakes that we've had of Dodd-Frank.